So passive income is one of the big goals of being a better developer, is getting to the point where you can, build products and you can provide services where your rate, or at least your effective rate, is just incredibly high. So you can essentially be living on a beach somewhere and doing the little bit of work that you need to do. And one of the ways to, there's a lot of different ways to get to passive income, but investments, making your money, work while you're asleep, is the original, probably the original way of having passive income. I guess you could buy slaves or something like that way back in the day, but essentially that was still, you were using your money to work while you sleep. And now, and with technology and everything else, we've started to bring investing to the masses, as it were. And that's where we get to the idea of micro investing, which is the idea of not having a whole lot of money to invest, but you still now have the ability to invest. You don't have to have some big, pile of money that you start off with just to start, buying stocks or real estate or whatever it is you invest in. Now you can have just essentially pocket change that you can use to start investing and start getting some of those higher rates of return, which is awesome considering savings these days are, down to about zero. They're actually they're negative if you can figure in cost of living and things like that. So to get technical on the definition, this is actually kind of talking about micro investing platforms. We're going to get a little bit more. We're going to stay a little more general, but just if you search for micro investing opportunities or things like that, you're going to see a lot about micro investing platforms, because that's really what they are. Is that there's always some sort of platform or something that enables you to be able to do the micro investing, because it's not, by its nature, it's usually not a direct, there's not a direct path from your investing dollars to whatever that target is that you're investing in. A micro investing platform, and I'll just read from the slide, is an application that allows users to regularly save small sums of money. Micro investing platforms aim to remove traditional barriers to investing, such as brokerage account minimums, to encourage people to invest, even if they have limited incomes and assets. All of these points are actually very important. Probably the biggest one is right there in the middle, is the traditional barriers to investing, which is almost always been account minimums of some sort. There is a minimum amount of money that you need to have to invest in certain things. Like if you wanted to invest even in a lemonade stand, you'd have to have at least enough money to go buy the water, the sugar, and the lemon to go make your own lemonade, or to buy the instant lemonade if you wanted to do that. There's always some amount of money that's required to get you to the point where you can get that first sale, or you can do something with what you're investing. And you could go loan a penny to somebody, which is basically what a savings account does. But how long would it take, or what kind of rates would you have to charge to even get a second penny based on that penny? So there's always some limit to it, some sort of minimum. But that's what micro investing allows you to do, is to say, hey, I'm not going to get maybe the full percentage rate, but I'm at least going to be able to get something back. And then I don't have to worry about the whatever that initial fee of entry is, or whatever that minimum is to get started. What we're going to look at in this one, we're going to talk about, with micro investing, really 5 areas. We're going to talk about stocks, P2P, which is person-to-person loans, real estate, venture capital, and then ourselves. Actually, as platforms go, we really don't need one for that last item, but I did want to mention that because it is one of those things. If you're thinking about micro investing, there are some considerations that you need to go through before you actually pick a platform. So I want to give sort of a full picture point of view. Stocks. Historically, transaction fees and minimum account balances to even start a brokerage account can be tough. They can be pretty high. Historically, they were, and by historically, I mean even, I don't know, maybe 5-10 years ago, and definitely if you go back 15 or 20, a lot of times it was going to cost you at least $1,000, and usually it was like $2,500 or $5,000 to get into just to start a brokerage account of some sort, to buy stocks. If you got into mutual funds, sometimes you had a little bit lower, but a lot of them actually had higher rates of entry. And if you went into something where there's going to be some sort of financial manager or something, there was, a lot of times it was 10,000 or 25,000, or you had to have a really solid net worth before you could do it. And then transaction fees, if you're even doing, $5 or $10 per transaction, if you're doing a lot of transactions, then that stuff can add up really fast. And particularly if you're buying, 10 shares of something that's $10 or that's $1 a piece, or even $10. So if you put $100 of investment and you buy 10 shares and you paid $5 on the transaction, and then you have to pay $5 again to sell it, that's 10% of your money that's gone in. Your $100 you invested, 10% of it has gone to fees. So that's traditionally something that's been a challenge, is if you want to buy something, you need to have enough money to invest to at least make the transaction fees negligible. So at a $5 to $10, you probably want at least $500 to $1,000 that you're going to invest, so that the percentage cost of the transaction is small enough that if you make some money, you don't lose all of that money, based on transaction fees. A great solution to this is Robinhood.com. We've actually, I think, talked about them before. I think they were a Nugget at one point. They have zero transaction fees, $0. You can buy and sell stocks for $0. You don't have to pay any money to buy it. You don't have to pay any money to sell it. The way they make their money is off of additional research tools and things like that they provide. They allow you, there's no minimum. So you could come in with $5, go throw it into the app and go buy, you can buy as many shares as you want of stuff that you can get for $5. You can buy one share of a $5 stock, or you can buy 100 shares of 5-cent stocks. You can get into penny stocks if you want to. You can buy partials. So you could go in, and if you wanted to buy 5% of $100 stock, then you could go out and get that share, and it's okay. You don't have to worry about your transaction fees killing you, which makes it really nice. So you could say, I want to work my way up to a share of Amazon, which is at about $1,500 a share right now. And you can say, well, I'm going to just put $5 a week into my account and then just buy shares, and then eventually have enough money in there and I'll be up to one share. But along the way, I'll be, instead of me having to wait and after whatever that be, a year or 2 or 3 or whatever to get to be able to afford one share, I can start getting some of the benefits of that early on. And that becomes really important a couple of points down here. There's also a place called Stash Invest, which is slightly different. And there's a couple like that, which are, they're sort of socially conscious investing sites, but that's at least what they really push. But what it comes down to is they allow you to sort of build your own personal fund. Is that you talk about what kind of companies you like, what kind of industries, what all of these different little restrictions are, so that with that, they go and find companies that match and then buy shares and then invest in those companies based on what your desire is. So if you wanted to get into only green companies, let's say, then you can put that in there and they're going to look for green companies. If you want to do only companies that deal with new power types, or if you wanted people that companies that only deal in non-GMO vegetables or whatever. I don't know enough about all of those, but if whatever your little special thing is, you can actually tweak your investment criteria. And what they're going to do is they're just going to go find a bulk of companies that do that and then start putting your money into it. Now, there is a higher starting fee. I think it's $500 to get into Stash Invest. A couple of them I think you can get in if you do a monthly deposit of as low as like $25 a month, and you can get into them. Now, those are going to be a little bit more. We're still calling them micro investing because you are investing small amounts in all these companies. The problem is that the way you're doing is it does add up to enough that you've got to have, again, enough money for your entry fee. So it's not quite micro investing, but it's also not it's not unreachable for the average Joe. I mean, you could go in if you get if you get a tax check back, or you get a bonus, or maybe you have just a good month, or you cut back on your Starbucks a couple times. You can put a few $100s together fairly quickly. And if you use some of these other methods, then you can put those, a little bit of money together, let it earn some money, let it snowball up, and the next thing you know, you can jump into some of these other options. Drips. If you're talking stocks, and especially with like a Robinhood and some of those kind of places, it's really awesome. Now, the nice thing about the drips, which is a dividend reinvestment plans, what they do is some stocks, you don't just make money based on where the price goes up and down. You also have a dividend. So usually it's paid out quarterly, and it's just you get X cents per share that you own. So if they pay you $1 a share, and you've got a share at the end of the quarter, they're going to put $1 into your account. Well, what a drip does is it says, I'm going to take all of that money that's going back into my account, and I'm just going to immediately reinvest it into that same stock. So if I've got $1, if I've got $10 invested into a stock and I get $1 back, it's going to go buy, if it's a $10 stock, let's say, it's going to buy a tenth of a share. So now I've got, 10.1 shares. And then the next time around, I will get, instead of getting, $1 or whatever it would be, and say I get $1 for the 10 shares, I'll get $1 plus whatever that be, plus 10 cents or whatever for the other tenth. And then that gets reinvested. And drips are real nice because they don't, these are stock, these are tools and financial instruments that's part of the way it's set up. So you don't have the transaction fees. So you've got really effectively, you got all these little micro transactions going on based on whatever the dividend is, and it's turning around and just buying more stock in that. Companies love it because it causes people to buy more shares of their stock. It's awesome as an investor because you don't have to pay those transaction fees. Now, if you're doing something like a Robinhood or something like that, you can essentially do the same thing. If you get something that's not a drip but does pay a dividend, for example, like Microsoft pays a dividend. So if you go buy a share of Microsoft and then quarter comes around and they pay out the dividend for that quarter, well, you can turn around and take that and buy some percentage of another share of Microsoft and rinse and repeat. So drips are awesome. Those are great ways to take your money and allow it to just go snowball itself. Now with stocks, whether it's mutual funds, however you do it, there's tax implications, and there are about all of these things. So definitely, one, do your research. Two, take a look at what happens to the money that you make on this. Is there certain rules around it? With stocks in particular, there are a lot of rules around how long you own the stock or how long you hold the stock. So it had to do with day trading and things like that, where people were buying and selling large shares really fast, and it was making the market really volatile. Plus, they just traditionally, you're going to make more money if you hold rather than try to do a lot of buying and selling. Stocks are a long-term investment. So the tax laws are actually built to sort of nudge you in the way of holding on to your stocks longer rather than just buy them for a couple of months and then dump them. We talked a little bit about partial shares. That's you can't go from account to account, but within a given account, you can buy partial shares of stuff, so you can work your way up to full shares along the way. And you can make some, depending on what the shares are, you can make some serious money. You can go Berkshire Hathaway's, their high-end stock is like, I can't remember what it is. I think it's like $250,000 a share right now or something like that. But it still makes, it still moves pretty nicely. It's a pretty good investment, but it's just not a lot of people have $250,000 laying around to buy a share of a stock. So you can put $5 into it, and at least your $5 will get some of that percentage, get some growth as well, and get to take advantage of that. Mutual index funds, if you don't want to do the research as much, then you can find there's a lot of and there's all kinds of books and sites and podcasts on this that instead of actually learning about individual stocks, then you can go get into a mutual or an index fund. Basically just takes a bunch of stocks. An index fund is going to be based on stuff that's grouped on an index like the NASDAQ or Dow Jones. Usually they're not that big, although there are up at that level, but they're usually more like biochem stocks or something like that. You'll find index type funds like that. And then you'll find a lot of mutual funds that will do the same kind of things. Mutual funds you're probably exposed to if you've got a 401k. Just about everybody's 401k is going to mutual funds, and there's some stocks. Or there's going to be all kinds of stocks you own through the mutual funds. The problems with those are you're probably not going to be able to micro invest into them. You're going to have to dig around a little bit to figure that out, because usually those are going to require you some amount to get started, to at least buy a share of each of the stocks that they've got in there. And that's not exactly how they figure it out, but there's a cost of entry. With stock market, if you're going to do anything here, you want to be you need to be thinking long term. This is money that you're not going to need in the near future, at least not this year. That's probably the easiest way, and probably not next year. That would be, if you figure 18 to 24 months is sort of your shortest time span to hold stocks, and let's say just absolutely tank, then that's probably your best bet. You'll find that that's going to pick up a pretty good rate. Stock market traditionally is over any, I think it still holds it over any 20-year period since 1900. It averages, I can't remember, like 8 or 10% a year, annual return, something like that. And that's not including dividends and things like that. So you can do pretty good, but you got to hold on to it for a while, and you can't be too scared about it. It's going to bounce up and down along the way. That's just sort of what it is. If you get into stocks at all, go with what you know. Depending on what you can or can't research or what kind of time you have. If nothing else, just look around like the products that you use all the time. For myself, like, I bought some Netflix because I use Netflix all the time. I bought some Amazon because I use Amazon stuff all the time. I hate Microsoft, but I bought Microsoft anyways because I see their products everywhere. I've got a lot of Apple stuff. I bought Apple. I'm a tech guy. I buy tech stocks. And then there's a few others that, because those are hobbies or other things that I know. So, go with things where you sort of know those companies. And if not, do the research. And actually, even if you think you know the companies, do the research, because you want to get a good idea of what the books look like and things like that. And you'll learn a lot of terms, but it's worthwhile to do so. And if you're micro investing, by its nature, you're not going to be buying like a whole bunch of different stocks, because you're just not going to have the money to do so. But as you grow, the more you can diversify, the better. If you pour everything into one stock, it may be a huge winner and awesome, but you're more likely to do better off if you've got a diversity in your portfolio, particularly if you're in one sector or line of business. That it may be something like you're in. Let's say you're in oil, you love oil and gas, and you do a lot of that, and then suddenly you have a big oil spill and all of the companies tank for a while. Well, that means all of your investments are going to tank. So if you can diversify, you're always going to be better that way. Yeah, you're high. The upside may not be as high, but you've reduced your risk a lot, which is always a good thing. Peer-to-peer lending. There's 3 places I'm going to talk about, but the 2 that are really big in this are lendingclub.com and prosper.com. In both of these cases, you can be a lender or a lendee. Basically, you can go out to the sites and you can go get a loan. And the thing about those is that essentially the loan is financed by other people that have crowdfunded their loan. If I go get $1,000 loan through Lending Club, there are people that can, there may be one person that's put the whole $1,000 up. More often than not, it's actually multiple people, and probably down to it's probably a bunch of people in $25 increments that have funded my loan. Prosper is the same way. Both of them, they've got really you can get in as low as $25 or $50. Their rates are pretty good, but again, because it's a loan and you have to wait for it to be paid back, you got to figure, if you've got a $25 that go into a loan and it's an 18-month loan, it's going to take 18 months to get all of the the $25 back. And it won't really take that long because they're paying interest and things like that. And hey, if there's a late fee or whatever on it, then you could get your $25 back quickly, but you need to expect that you're not going to need that for at least 12 to 18 months. And it may be, I think they've got it set up so you can sort of, you can limit what kind of loans that you want to put your money into based on what your time frame is. Upstart is like the other two, except for they're much more focused on its business loans and college students and things like that. So it's really helping out startups, whether they're people or businesses, is really the focus of Upstart. It is Google funded, so it's got some big backing behind it. But you got to look at it as well as like, what's the risk of me not getting paid back on some startup company? How often do startups fail? Pretty often. So you got to look at that kind of stuff. And of course, with any of those, if somebody doesn't pay back the loan, then however much they didn't pay back, you don't get it back. So that has to factor into your calculations for how much you make. So even if you got a whole bunch of loans out at a 10% rate, if any of them default, then you're not going to get your 10% back. You're going to get whatever it is, 9.5 or 9.8 or however it works out. Again, the way to win at these the best way to get good numbers out of these is to diversify, is to make sure that you've got, dozens, preferably, hundreds of loans that have, or people that you've loaned money out to through this site. Because then, it's just more likely that just by odds, not too many of them will default, and you'll make enough money on the ones that you don't, that it more than covers for the defaults. These are pretty good rewards. They're going to make, I think there are a lot of different numbers around there, but they're typically going to make 5 to maybe 12 or 13% annually back. There is a complete risk because you could have that money go out, that person pays 0 on it, never comes back, never pays a single cent. You lose it all. But of course, if they make even the first payment, then you'll at least get a little bit of that back. So it is a complete risk, but you got to figure, you're normally going to get at least some of it back. But, the bonus is really low cost of entry. So you don't have to be a bank anymore to get into the loan business. Real estate. Real estate has a very high, of these that we've talked about, it's probably a higher risk, but probably typically higher reward. Fundrise.com/investments is a place to go there. Now, this is a little bit higher. You have to have at least $500 to get started on it. There's a couple other sites that are bouncing around that I think may have some options, but that they really haven't gotten down there yet. You're probably going to assume if you're going to get into the real estate side of it, you're going to have at least $500, which is still, considering if you're buying real estate, it's pretty, it's a small amount. Liquidity may be an issue if you're dealing with this, because in order to make money on it, if it's a rental or property or business property, then you probably have some money coming back in. But if it's where it's basically just the property being, has purchased, and then somewhere along the way you're really waiting on it selling to make your money, well, your money's going to be tied up with that until it gets sold. So this again going to be something you need to be looking longer term. These sort of new, not sort of, this is a newer way to go about stuff. Microfunding, or real estate in general, the rules change regularly. Microfunding is very new, or crowdfunding of real estate investments, microinvesting. So read all the fine print and make sure you know what you're getting into. There's again, tax implications and things like that could be related to having these bits of property, and it can get a little complicated because those bits of properties may be in a state that you're not in, and so you may have some different tax laws and all kinds of fun stuff that can make that tax nightmare at the end of the year, depending on how you work through it. But as you get more money and the size of the crowd that's funding some of these real estate ventures does allow you to essentially have like a piece of a mall or a corporate complex or high rise or something like that. So it does allow you to actually get a piece of the pie way earlier than you otherwise would have been able to do so. Venture capital, microventures.com there's other places out there like this, but they're really like the one right now that is truly, has got all of their ducks in a row, and they're, FDIC or whatever it is rated, or it's not FDIC, but it's as a investment tool that they're rated. You're a venture capital angel at this point. If you go into microventures.com, you can do whatever amount. You can do $5 into something. However, there's a total risk. You could be investing in Facebook, and you could have a huge payback out of that. You could be investing in pets.com or whatever, that the first time around, and get none of your money back. And there's a lot of startups that die, horrible deaths. So really, again, this is tough as anything, I think, as far as research is concerned, because you're going to have to look on a company by company basis, look at if they've got a prospectus, if they've got any kind of documentation. Again, if you can actually talk to them, or the people that run it or something like that, you can, then you can figure it out a little bit. If it's somebody that knows the business, that understands what they're doing, maybe they've done it before, things like that you can use that to reduce your risk a little bit. But nevertheless, you're still talking pretty high risk. I do want to mention Kickstarter, because that's something where you could sort of think of, hey, I can put some money into a product, but that's not. Kickstarter is crowdfunding, and it's not venture capital. The crowdfunding that you're doing for Kickstarter, you're really just sort of paying for products before they've been created. You're not actually investing. I don't think I've seen any Kickstarter campaign that is really investing. I mean, I guess you could say you are, because it's stuff like, oh, well, I'm going to put $100 in, and I'm going to get this product for life. I'll be licensed it for life. So I'm sort of investing in the fact that I'll be able to do that. Well, yeah, but not really. So Kickstarter is not, a venture capital or angel investing kind of site. You can definitely, this stuff can be very inconsistent as far as the venture capital stuff is concerned, because it's a bunch of different businesses. It's not like you're able to do an apples to apples comparison against them. So you and then when you get the money back, how you can get back out of it can be a little bit tricky. And there can be some overhead related to that as well, as far as like time spent getting into it, and the research and things like that. So from a micro investing, you're going to be spending a little more time in it, a little more. There's going to be essentially more invested in it. It may not be in money, but will be in some time that you spent researching it, and maybe even talking to the companies, and maybe eventually you're in a situation where you do have, as an investor, and if you put in enough, or if you work your way up to enough investing in a company, that you've got you've got shares, and you're in shareholder meetings, you get to know the management. There's a lot of learning that you can get just sort of watching some of that from behind in the shadows a little bit, and watching how these companies progress and what they do. Maybe a way for you to learn how to do your own, kick off your own company. Investing in ourselves. Got to mention this, because it is there's no platform required, and you don't have any overhead costs or anything like that to worry about. One of the best ways to invest in yourself is reduce or eliminate your debt. If you have high interest debt, you're going to have a hard time finding ways to earn money at that rate. So the faster you can pay off debt, the more you're going to have more money available to do investing of any kind, micro or macro even. There is the option, depending on how you do it, reducing debt. Maybe you don't need to go to zero. If you've got some really good low interest loans, like student loans or something like that, then instead of paying those off right away, then maybe you look at some higher interest investing as a way to feed the money to pay off those low interest loans. This is definitely not Dave Ramsey certified or anything like that. That's not Dave Ramsey approved. But if you look at aggressive money managers and stuff like that, you'll find that that's often what happens, that people go find low interest loans. They turn around and find ways to use that money to make higher interest investing and make their money on those margins, basically. You can incrementally build a business. We've talked about a side hustle or building your own business. Well, maybe what you do is that there's some sort of inventory that you need to have to start your business, or maybe there's some tools that you need, things like that. Maybe you start, you don't have to buy everything at once. So, if you're an auto mechanic, you don't have to have all the different bolts and wrenches and ratchets and all of that kind of stuff. You could actually buy them, one at a time. Essentially, you can go a little bit here, a little bit there. So you could essentially micro invest into your business. Maybe in the same way, maybe go out and get like a virtual personal assistant, or outsourcing, or save up some money to do some little special projects here and there that will allow you to invest in yourself and become, maybe it's you go get a physical trainer to allow you to get more healthy. Maybe it's you go out and you can hire somebody to be a mentor, or get yourself into a class, or do some continuing education things, or actual education. Maybe you save yourself up, save your way up and work your way through over a long period of time. Maybe you get a higher level degree, invest a little bit and buy a class here, a class there, a certification book here, certification book there, and work your way up to being more educated and certified. Going the slow route, the slow and steady route, instead of trying to pour a bunch of money in right away. All these options, at some point you got to choose a path. What are you going to do? What are you going to look at? Now, you can go all over the place. Since these are small, you could actually jump into all of these. It's not like there's any one really precludes another. But whatever it is that you're getting into, think about what is really your risk tolerance, and really that comes down to so what if I get none of this money back? Is that going to change my livelihood? If it is, then you probably don't need to be doing it. If not, then you start figuring out on how much can I actually afford to invest. No matter what path you take, research the options. Look at what's out there. Look at the platforms that are out there. Make sure that a new one hasn't come up that's maybe a little better deal, or gives you better rates or anything like that, better returns. This is micro investing, so don't be afraid to dip a toe in. Put $5 here, $10 there, $25 there, whatever. Check this kind of stuff out. Myself, that was how I got into Lending Club. Is I had a little bit of money. It was around Christmas time. I had a little extra money. I said, I'm going to give this thing a shot, and was very happy with it. I was very pleased that I did. With Robinhood, it allows you to put practically nothing into the stock market and start playing around with that. Go buy some penny stocks. Go buy little bits and pieces of small or lower cost stocks that are out there, and start learning how that works. It's definitely skills that will that are useful to have, to say the least. With any of these, if you want to learn, one of the ways as part of researching and learning more, don't be afraid to go check out some business investing magazines, blogs. Some good examples. Money Magazine is aimed basically, or at least it was years ago, and I think still is aimed basically at entry level people getting started on investing and saving and things like that. And it's interesting because it sort of cycles through articles about once a year. So if you get a year or two of a subscription to it, you probably got most of their content. I mean, stuff will update here and there, but it's sort of, you'll get the gist of what you need to over that period of time. Or if you just go to a library and go look at the last years and just read through those. There's also Fortune is pretty good about that kind of stuff. It's maybe a little higher end, but it will you'll see trends and things that may help you with ideas for investing. Inc. is really more into business building side of it, but looking at what's out there, and particularly if you get into some of the venture capital kind of stuff or angel investing, if that's where you're drawn towards, I definitely look at an Inc. where you can see what kind of businesses are out there, what are they doing, what are they struggling with, what's likely to succeed, what's likely not to succeed. Harvard Business Review, they've got multiple podcasts and articles and stuff that you can pick up there that get into really dirty details, deep into the details if you want to, of investing. Talk a lot about business. There's it's a wide range of stuff, but if you want to understand business from top to bottom, inside and out, over time, you're gonna get a lot of good articles on that. It will definitely help you build your foundation of knowledge, which is going to be useful in any of these kinds of investments. Wrapping up, this part of it. The goal is to grow to big investments. Micro investing is not to stay micro. It is to find some ways to take that, earn some money, reinvest that money, and eventually make it grow to the point where you can go nuts with it. Self-funding is awesome. If you can get to a point where it's not really, if you're looking at it not from I just want to grow my investments, but I want to be able to pay for X. It's not retirement, but like, for example, if I want to make a car payment, maybe I look at a couple of these things and say, okay, how much money would I need to invest and get back, X rate, 5 or 6 or 8 or 10%, or how long would I have to have that money sitting around to the point where I could basically pay for something off the interest of this investment. And micro investing, you're not going to be able to pay even for a cup of coffee, but if you can get some good rates, you could. I don't know why you would want to invest $500 just so you could, get enough money to buy a cup of coffee every quarter or something like that. But if you can work your way up to larger amounts, then that's exactly what you can do. And of course, that is the key to retirement, is getting to the point where ideally you have so much principal that you're just living off the interest. So you can retire and live for 1,000 years and you're fine. You've never touched the principal and you're just living off the interest. The sooner you start, the better. That is the key, no matter what. Whenever your money starts, whenever you invest, that's the point where your money is going to start earning money. Until that, your money's not earning anything. So, like I said, dip a toe in, give it a shot, see what happens. All right, questions, comments?
Hey, Rob.
Mm-hmm.
With a lot of the investments, have you seen any that are like micro investments in like VRBO or any type of vacation or rental properties?
I don't think any of the real estate ones were, because that's just not, it's a little bit of a shell game anyways, with a lot of those, unless you go, if you're going to get into something like that, then you're better off. That's usually, it's like your best bet is to go in, either crowdfund it, go in with a couple of people and go buy a place that's a rental place that you're going to, like say buy a place on the beach, and it's roughly a timeshare, but not really, because at that point, like say you go in with 4 people and you guys buy a building and then you just split whatever the proceeds are based on renting it out as many months, during the, or many weeks during the year as you can. I haven't seen anything that really gets into that, because it's not as reliable. I think it looks like all of the investments were more commercial kind of stuff, but it may be you'd have to look a little deeper into it, and it may just depends on what the inventory is that they're investing in at a given time. Maybe those things do pop up, but usually at that point you're better off probably to invest in something that you're going to work your micro investing up to the point where you could put a down payment on something like that, and then go get a vacation home kind of thing that you could rent out, and then which we talked about actually before we started this presentation. Then you get a situation where if you do it right, which is not too hard to do, that essentially your renters are paying your monthly payments for you over time. You build up some equity, buy a second, a third, a fourth, a fifth piece of real estate, and the next thing you know, you've got a nice big inventory, you're making some real money, the prices go up, and maybe now you can make some real money, and particularly once things are paid off, then now it's the renters are essentially just straight out paying you money, or at least cover expenses plus whatever's left over then is paying you money.
Right, I'm familiar with that model, and I've been looking at that more closely recently. But I was just curious if there was like a place where, like, if people were looking for partners to go buy property or some type of crowdfunding for that. So if you haven't seen that, I'll just
it didn't jump at me, but I'd go Google real estate crowdfunding, or real estate. It's probably real estate crowdfunding versus real estate micro investing. You're probably more likely to find that. There are, because I saw some stuff, but they weren't those kinds of pieces of real estate. But there were some sites that were crowdfunded real estate investing that were, the entry level is much higher, but they were definitely getting into bigger pieces of property that they were dealing with. So you may do that. And again, that was, like I said, I was focused on micro investing. So I think that's if you take the micro off of it, then you'll probably find some opportunities for that. I can't imagine you wouldn't. It just seems like it's popular enough that I would think there's several places that there at least some crowdfunding to get into that.
Okay, that's cool. Appreciate that. Yeah, we've been eyeballing selling the house, upgrading the house, renting the house, moving, buying multiple properties. I'm just not sure what direction to go in. That's why I was curious about that.
Yep.
Yeah, I had a kind of question, comment. I wanted to see what y'all thought about. I mean, I know 401k is a good investment, right? Like I've been putting into mine for a little while, for about 6 or 7 years. I've been doing about 10%. And I'm starting to wonder if it's better to do the 401k or if it's better to invest that money in something now, like especially if, you go into like real estate investments, then at least you have the option of if you need that money or if you need to sell a property but with 401k, you're locked out. And if you do need it as an emergency fund, then, they're cutting a big portion out of it.
Yeah, it's generally speaking, you want to maximize your 401k because it is it's because of the tax implications. Particularly, if you've got an employer that matches, you want to at least maximize the match, because that's a lot of times that's 2 or 3% of free money that you can get and throw it into the investment.
Well, yeah, I guess with the assumption that there's no matching, like my company doesn't match. So I've actually heard from other people that like if your company doesn't match, it's almost not worth it to put into a 401k. Well,
it still is because of the taxes related to it and how those things work as a retirement fund, which you should. It's one of those things you should be saving retirement. And I mean, I know a lot of us statistically don't these days, but should. So I would probably, I would look at it and I would, if you've done really well with that and you've done a good job and you think that, that's money you're going to need, or you're, maybe you want to look at, buying a bigger house or something like that. And then maybe you adjust your savings, somewhat and put some of that savings into something that is more liquid, that you have an easier way to get a hold of it. But that's also part of the whole point of a 401k is to sort of, it's forced savings in a way, is that it's like really painful to pull that money back out. Although you can with 401ks, depending on what you need it for and how they're set up, a lot of them, there is a way to borrow against your 401k, which is actually a pretty good deal, because then the interest that you pay on the loan goes back into your 401k. So you're basically paying yourself interest. So there is some things you can do with 401k money that you can access it if you need it. And it's also, I think it's like if it's medical emergencies and a couple other things, there's a few ways that you can get a hold of it if you really need it. But ideally, that's the point with a lot of this stuff, is you don't want to really touch it until you have to, ideally until you retire. And then, even then, if you're lucky, you have it set up in a way that it's making enough money that it never actually goes away, that you're living on the interest and never have to touch the principal.
Yeah, the way ours is set up is I think it's like you're talking about the taxation or whatever. It's pre-taxed, and they gave us option like 3 tiers. There's like the risk factor, I guess. You have like a green, yellow, and red kind of chart, and I just went in the middle of the road. When I first started doing it, I did the more risky one. And, that was quite a few years ago. I kind of, once I settled down and had kids and everything, I kind of went to the more middle of the road one where it's less risky, but I almost feel like maybe that should be pushed out and stay with the riskier ones. I mean, at what age? I don't know. 401k is still kind of a mystery to me as far as I've just heard, my parents told me just put into it and you'll appreciate it when you turn 60. That was basically their only advice. So
it's, I mean, they're sort of safe. I mean, because typically they're going to be fun. And that's what they're going to do is they're going to have, 3 or 5 tiers of risk, depending on where it is, what the tiers are and how they've got it set up. Usually they've got documentation. They'll even say, you should be at this risk level to this age and this risk level at this age range and this risk level at this age range, because it basically has to do with the idea that what if all your money gets lost and do you have the ability to earn it back? Yeah. So if you're in your 20s and 30s, I think even in your 40s, I can't remember where you usually start, but usually definitely in like your 20s and I think usually in your 30s, they're like go all out on the risk, because even if you lose everything, if you're 40 and you're at zero, you still have plenty of time to to earn it back and to get back to it. So it's not a big deal to to lose that money. I mean, you don't want to, but you can afford to. And the upside, is that maybe you make a ton of money in there. And the way most of the 401ks work, the mutual funds and that, they're not technically, yes, you could lose everything. All the companies could go kaput, but that's not going to happen. The way they balance stuff out and they do a lot of things so that you're going to get pretty good returns. The risk tends to be on the high risk, whether you get 0% versus 20% or something like that. So I'd look at them historically. It is a good instrument, and particularly early on, if you're not making much, like these days, I think it's like up till $50,000 on a salary, it's basically zero tax. There's nothing taxed on it. But then as you get into that, as you move from 50 to 100 and then 100 to 150, and the taxes that you pay on that stuff start to change. Then of course, once you get above whatever is 150, 200, 250, I think where stuff's where they count you as totally rich, then the tax implications become huge, because every dollar if you get to the top rate of whatever 37% now or whatever, that means every dollar that's pre-tax, that's 37% of it that you get to keep, as opposed to giving to Uncle Sam. So there's some things like that definitely, as you get into your prime money earning years, your 401k becomes a very important friend of yours, because taxes can just absolutely obliterate your earnings.
One of the other things too I found over the years is, if you're worried about putting money into your 401k, at least put something in. So use the 401k calculators for what the difference is versus what you put in versus what you get back. So I found for years that if I put 4% in, I only lost like $20 or $30 off my paycheck, but the money was still going into the 401k. So even if I was getting more than 4% back a year, that's higher than you get in savings. That's still better than nothing. So even if you're putting a little bit in, if it's a very small hit to your paycheck, it's tax-free till later. So it's just something to consider, how much you could put in versus how much you lose out of your regular paycheck. But in the same token, like right now, I mean, I've seen returns on my wife's and mine anywhere between 8 to 24% per quarter. So it's hit or miss. It is a gamble. But the other thing too is, if you watch what your investments are doing, for instance, when the housing market crashed, everyone knew that was coming. So I moved everything to money market right before that happened, and a lot of the investments I had tanked, but because I was in money market, I was basically making inflation, and then once the market started to improve, I moved everything back in. So you don't have to watch it all the time, but if you start seeing, like right now, we're about to go into a potential trade war. So you might see the stock market start to take a hit. So far we haven't. So stocks are still good, but you start seeing them go down, just shift your risk on your 401k to minimal, either money market or low risk, and then your money basically goes from those high risk stocks and bonds to low risk, so you're not losing as much money. It's just you got to be a little conscious of what's going on in the economy.
Yeah, it's almost like playing the stocks through your 401k in that sense.
Yeah, and it's
a little bit. It's not as bad because the financial, like the 401k companies, do consider that. So, like, if you're at the high risk, yes, you need to watch the markets. But if you're like in the low risk, you can pretty much leave your money there. You may take a small hit, 1 or 2 quarters, but you're really not going to be negative for a full year or two.
Yeah, now, see, my original thinking, and I was a bit younger going into it, was, I'll get it to 10% and then I'll put it on cruise control and I just won't even think about it, which in all honesty, I kind of let, I don't check on it. I don't really pay attention. It was almost one of those things like, get it going, forget about it, and then think about it at 60, when I'm 60 and then see what I'm at. But now I'm starting to look at, obviously what I've said, I'm kind of wondering about if it's a great investment. So I'm going to be moving out of the job I'm at now and into a different position with a friend of mine as soon as I get done with my boot camp. And they offer some 401k matching. So my thoughts were match that, get to where I'm using their full matching, and then just kind of stop it right there, let that go, and then work on other investments with some of the money I'll have left over without putting quite as much into my 401k.
Yeah, that's
actually a pretty fit bet.
Yeah, that's a good approach, and it is that is the goal of a 401k, is that it's just there. There's some money going into it. It's growing, and as you get closer to retirement age, you look back and see what's there. These are investments that are probably in addition to having a 401k. Pouring money into that, taking advantage of that, so that you don't, wherever you can, because it's tax-free money. It's not taxed. So it's going to reduce your tax bill a little bit. Now, I mean, you'll pick it up later, but you'll be picking up when you're not making as much money theoretically. And that at least gives you, that should actually, having a good 401k should actually give you some buffer to take on more risk elsewhere. Because you'll say, I've got this other money that I'm investing over here in this other thing. And if I lose all of it, I don't care, because I've still got all of this stuff sitting in a 401k. So it's where you want to diversify. If you've got a couple different places you put it, then whatever happens, you're not as likely to get completely whacked, because wherever something goes down, usually something else is going up.
Yeah, kind of, I guess, have it like, you have your cushion, just your regular savings, just to be safe, and then you have your 401k cushion that's back there, out of sight, out of mind, where just a little more comfort knowing that these other investments, if something happens, worse comes to worse, I still have that. I get what you're saying there. It's kind of a confidence thing going into your other investments, knowing that you're all right.
Yeah. And that's how I do. I mean, that's how I do it. I've got, I don't know how many layers it is now, but I've got layers of investments that are partially about the risk, but partially about the accessibility as well. So I've got I've got the simplest thing, which is just a little savings account that doesn't earn really any money, but I've got, money sitting in there. So it's basically a rainy day fund or an emergency fund. So if I've got a car dies, I've got a little bit of money to go, get new tires or get the engine repaired or whatever I need to do. And then the next level back, I've got a little higher yield in savings that I don't touch as much, and usually try as stuff in that first savings get to a certain level, then I start pouring more into that second one, which is really, then it's like, okay, well, if I need to go buy a car, or if I'm going to go buy a house, or if I'm going to go, maybe like if I want to go on a big vacation or something, then maybe I'll go as far into that level. And then the next level after that, then I start getting into stuff where I've got investments of various sorts. I've got, stocks, or I've got like Lending Club and some of those kind of places where those are things that I don't feel like I've set it up so that I'm probably not going to need that money in a pinch, and not, like immediately. It's not like I'm going to turn around and say, oh my gosh, I need all that money today. It's not like a horror movie or something, or gangster movie where they're like, oh, you need 10,000 tomorrow, we'll break your kneecaps. This is something where, I can put a little more risk into it. I can get a little better rate of return on it, because I don't think I'm going to need that anytime soon. It's at least, to me, it's like the first level is I'm not going to need this for hopefully for a month or two. The next level is I'm not going to need this for, maybe 3 to 6 months. The next level is I'm not going to need this for 6 to 18 months. The next is I'm not going to need this for 18 to, for a couple of years. And I get, you get your way back to my retirement fund where it's like, I'm not going to need this for decades. And so that it's just the money that goes in there. My expectation is that I'm not going to touch it again until, way down the road, until I'm looking at retirement. That's when I'll actually come back and do it. And I can leave that pretty high right now in its risk, because I'm still pouring money into it. I know I'm going to be steadily pouring money into it. I don't have any need for it right away. So if the market goes down really bad, I don't actually have to move anything. I can just wait for it to come back up, assuming that it will. And a lot of these places, they've got financial managers, and you're not investing in stocks, you're investing in a fund. And even with the high risk stuff, there's going to be some measure of like cash instruments, and there's going to be, they'll do some balancing around and stuff like that. Because if that fund manager has a loss for a couple of years in a row, they're going to end up getting fired basically. So they're going to do what they can to move stuff around to at least protect the wins where they can. And, depending on that level of risk is essentially how aggressively they're going to go after trying to earn you some of those higher rates.
Something else to consider too. Oh, go ahead.
No, go ahead.
I was going to say something else too. If you're looking at just saving money and you don't want the risk of like stocks or bonds, something else out there is called Smarty Pig. It's an international banking system for saving money. It's a little bit higher interest rate than some of the local banks. What's interesting about their little package is you set goals for what you want to save for. So say you want to buy a car, you set it for like $20,000, and then you start putting your money in until you reach that goal. Or say you want to do Christmas shopping and you want to save $2,000 for Christmas. Well, what's cool about it is at the end, you can then turn around and turn your money into like gift cards. And they'll give you like a 5% or 20% towards a gift card. So you get more for your money on top of the interest.
Yeah, I could see where that would be pretty handy going into like the holiday season with that in mind.
Yeah, those kind of a couple of times for Christmas. And I've walked away with like almost 2 free $50 Best Buy cards if you do it right.
Well, my kids are getting to that age anyways where they're like, I just want a gift card. So it's perfect.
Yeah. Well, I've always done that. I've always had a Christmas savings as well, that just every year I put, that's one of those savings accounts. I've got one that I've set aside, and I put, whatever it is each year. It's a little different. It's, X amount of dollars in each month. And then you get into, basically by the time I get into November, then it's like, it's pretty far up there. And then I've got a ton of money ready to go for, Black Friday sales and things like that. And then use that to cover all the gifts and stuff like that, and just general expenses around Christmas. And it's sometimes, I blow through that and then some. There's been other years that I've had a little bit left over, and so it's just one of those things where if you can get a deal like that, like Smarty Pig has, where you can get a couple, get a little cash back or some sort of reward based on it, then it's worth looking into. And with that, there's actually was one site I was looking at doing the research was mentioned like reward points and things like that, where it's really, I guess it is sort of passive income, because it's basically, if you set it up right, where it's money that you're normally spending, but you're getting some cash back based on it, then or travel points or some of those kinds of things. And sometimes that can be a good way to look at it too. But that's like everything else we've talked about. If you can spend a little time beforehand and think about it and know sort of what your expenses are going to be, particularly if you're going to have a big expense, then you can dig around a little bit and you may find some good ways to to finance that ends up getting you a free something or another, or gets you a lot of cash back, or you get a little bit better deal, or things like that, or if nothing else, if you can save it up, so your savings, at least it's not only what you make, but what that money made while you were saving it.
Isn't it really I forget the name of it. It used to be like Money Share or eShare. Basically, they use affiliate marketing to give you cash back on your purchases. Do you remember what that is?
I don't remember what that is, but yeah, that was what I used that that was the basis for the affiliate marketing site I had years ago. It was that, and I think it is eShare may have been the one that was that did that well. And that's actually, a pretty good deal too, if you look at it. I mean, cause I think, well, there's several sites actually that were doing it where they would get points or gift cards or stuff like that. Which is not hard if you can get, all of your affiliates, if they're giving you, 5, 6, 7% or more off on stuff, or, affiliate fee for it. And you go give all of your, all your customers maybe 2% on their transactions. Well, you're still making a couple percentage points at least per transaction. So, something like that's actually not a bad little investment in itself, is to go in and invest some time, build a site, find a couple of good affiliates, and go through it that route. And you can even do it like some of these places do. You can go to a bigger level where it's like home loans, car loans, health insurance, stuff like that, where they pay some pretty decent fees for affiliates. If you can send them something, then you get a pretty good chunk of money. And so you could turn around and say, like, hey, if you come to us to try to shop around your car loan, we'll give you a $10 Visa reward card for doing it, or something like that. I mean, there's things like that you can do that, and you can still make some pretty good money off the whole thing.
Yeah, this was a pretty interesting episode or meeting, actually. I think this is a good topic. Yeah,
it's always it's good to occasionally drift into some of these other areas where we don't talk about as much, but we probably should know. Just wrapping it up. So basically, we talked about where stocks, peer-to-peer lending, venture capital, real estate. Honestly, there are more options every day. It's like I sort of look at this stuff really about every year around Christmas time. Because I have some time, and I'll usually have a little bit of money, and I'm looking at ways to invest stuff and doing some research. But it's just like, it seems like every time I turn around, there's a couple more sites, there's a couple more options. Take a look at it, spend a little time here or there, maybe once a quarter. It's an excellent habit to save and invest. It's just, if you look at everybody that's rich, they saved and invested. That's just part of what they do. And then I came up with the 3 R's of this, of investing, as opposed to reading, writing, arithmetic. This one's risk, reward, and research. You got to look at what are you willing to risk? What is what's the potential reward that you're going to get out of it? And then no matter how you look at it, you got to research it. Look at your options, look at what you want to do, look at the costs involved, and then, take a shot at it. You're never going to be successful if you don't at least give it a shot. And thanks. I'm glad that it sounds like this was, had some really good discussions around this, as always. Appreciate your time. If you have any additional questions or comments or suggestions, you've got all of our normal ways to get a hold of us. And I'd love to hear that, particularly if there's some additional sites out there, some additional options that we haven't covered. And as always, our goal is making every developer better, but this time even making them a little bit more money along the way as well. So